From taxes to energy, it is also one of those political issues that's part economic and energy part foreign policy. It plays out every day in the trading pits. Today, November crude oil futures settled at $91.37 a barrel, down nearly 0.5%. We continue our series this week, Politics in the Pits, with Erica Miller and oil trader John Netto, president of M3 Capital.
How are traders in general viewing the election?
Well, the election is more or less, political opinions aside, is a known entity now. Obama's a heavy favorite if you look at in-trade. Also, if you follow the polls in the key states, the battleground states, Obama appears to have a commanding foothold there as well. And so the market, for a large part, is actually discounted an Obama win. And as a result of that, this is actually very bullish for risk and for oil as well.
How high do you think crude could go?
I think oil is going to cap at $96 or $97, not because of an Obama victory per se, but because of the bifurcation and economic growth around the world.
On the flip side, what happens if we get a Romney victory? Will the market still rally?
I think oil rallies in either case, but if Romney wins, it rallies a little bit more because the market views a Romney victory as more risk conducive and better for risk in general, which would send oil higher.
How big of an overhang is the political uncertainty for the market?
Much less now than it was a couple of months ago. As I talked about, the polls are very conducive for Obama. The market has begun to discount an Obama victory, and as a result of that, the sell-off we saw in crude was not because of any political uncertainty, but more about economic concerns.
Once we get beyond the election,
yes,
what will be the big driver for crude?
Economic growth, hands down. If we look at the crude contracts out there, one of the benefits of trading crude is that you can not only trade it on the front month, but many months as well to get a sense of what supply and demand is like all the way out 5, 6, 7, 8 years down the road. And if we look at crude right now, crude prices 12 months, 18 months down the road, it actually shows some economic weakness. So I think that with that being said, looking at the price of crude 12 or 18 months down the road, economic concerns are the biggest overhang to crude right now.
How does the environment today differ from 4 years ago?
4 years ago, we had a major financial meltdown. There was a lot of leverage in the market. We saw crude go from 147 down to 29. There were a lot of hedge funds and a lot of leveraging that was coming undone. That aspect doesn't exist this go around. As a result of that, implied volatility and realized volatility in the market is much lower.
John Netto, thank you very much.
Thank you.